Good afternoon, everyone. This is David Gilreath with Sheaff Brock Investment Advisors. Remember, we are the firm that uses innovative portfolios for intelligent investors like you. So today we're going to talk about inflation. It's all in the news. It seems like that's the only thing people can talk about, and there's all kinds of reasons for it. And people blame the pandemic and the supply chains. And currently, in the advertising world, the gold bugs and silver bugs are coming out of the ground, and the real estate deals are flooding the airways, commodity funds. There's even, I heard, a doomsday freeze-dried food commercial the other day. So there's all kinds of ways people want to get your money because of inflation. So today we're just going to talk about it and maybe where you might want to put your money. Where's the best place to invest? So inflation is here. Is it here to stay? We don't really know. Some people have different opinions, which we'll talk about. What if inflation really isn't the risk, and where might a person want to invest regardless of what happens with inflation? So right now, everybody knows inflation last month, it hit the CPI hit 6.2%. Got a lot of people into a tizzy, and the crowd is now shouting inflation, inflation. And in my career, when everybody's on the same corner shouting inflation, inflation, sometimes it's best to walk across the street and then maybe walk across the other street, and now you're on the other corner, and just maybe take the opposite investment take. I show that because this has happened multiple times in the last 40 years. Couple of instances of that would be Y2K, when everybody was all in a tizzy, and then we woke up on January 1st, and nothing had changed. Nothing really had happened. So inverted yield curve about 3 years ago, maybe, where everybody was all convinced the recession was right around the corner. Another example before my time, but was very evident, was when World War II ended, and the fear was of returning GIs who had no money and no jobs to come back to, and everybody was certain there was going to be a big depression, and actually just the opposite happened. So some smart people don't think that there necessarily will be ongoing inflation. I mean, Jerome Powell has bet his job on it, basically. Guggenheim Investments just put out a thing about how disinflation is really around the corner. Cathie Wood, the high-tech guru right now, really thinks there's deflation or disinflation at least. Financial Times recently put out a piece about it, and Jim Cramer, as goofy as he is sometimes, he is a very smart person, and he thinks that the seeds of deflation have been sowed and that will be evident soon enough. So another indicator that doesn't seem to be too worried about inflation is the bond market. Bond yields, 10-year bond yields, and the rate of inflation tend to go hand in hand over time. And there's this big divergence right now where inflation has popped up the purple line, whereas bond yields are still very low, which is the kind of gold colored line there. So let's look at places in the past of where you might have invested or what might have happened during different inflation readings. So what we did, we took 48 years of data, started in 1973, which was about a couple of years after, year and a half, 2 years after gold started to float. Gold was fixed in price, $35 an ounce for 40 years. And Nixon in 1971 took that apart, took that away, and it started to float. So this starts in 73 after gold had a chance to kind of normalize. But it goes back 556 months. So we took every month, and you can see in the second column the number of months that when inflation was between 0 and 1%, what happened in the next 2 years out? Or when inflation was, say, 3 to 4%, there were 112 months. And then what happened, going out 12 months and going out 24 months. So the far right-hand column is the total of the two-year period of time. So you can see commodities really have done poorly under most inflation conditions, except for when inflation is above 5%, that bottom corner, 17.8%. So when inflation is very high, commodities do fine. Let's compare those to gold, how gold has done in those same periods. And you can see that gold returned more than commodities at every period, except for, gold returned more every period than commodities. Every one of them. And even the 5% one where commodities did okay, up 17.8%, you can see gold just trounced it. Gold was 60%, so significantly higher. The next chart shows how gold did versus the S&P 500. So you can see that the S&P 500 also beat gold every period except for the above 5% time. So S&P 500 is right here being circled, did better at every period, every inflation tranche, 0 to 1%, 1 to 2, 2 to 3, 3 to 4, etc., all the way down until that 5% where gold actually did better. So you might, now inflation right this month was over 5%. Next month probably be the same. It might be the same for the next few months. And so maybe you want to add a little gold. Gold is an expensive thing to own, and it really doesn't produce anything, no dividends, etc. And you gotta pay to store it and things like that. That's a hassle to buy and sell. But gold has done pretty well over extended periods of time when inflation has been high. But in the long run, by far, the best investments are REITs and the S&P 500. So this goes back to 1975, and you can see that in the blue line down at the bottom is the inflation index, CPI. Right above that is gold, and then you have bonds, and then you have REITs and stocks. And so REITs in the stock market, S&P 500, have by far been the best investment during multiple inflation periods since 1973. That's all we have today. Have a good day, and we'll see you next time. Thank you.